Hello everyone, this is Professor Reiko, continuing on with our lessons on the accounting cycle. This is our fourth lesson in the accounting cycle. We've talked about our normal account balances and things like that, and then our previous one, which this lesson goes hand in hand with the accounting cycle 3 video, which was on all of our journal entries. All right, so if you look at the top, just to refresh from the last video, the accounting cycle, we start with journal entries, and the second step, which we're going to do now, is post to the general ledger. All right, so what I'm going to do is I'm going to take all the journal entries that we did in accounting cycle 3 on journal entries, that video, and I'm going to use those journal entries to post to the general ledger. All right, so if we read down here, we see the general ledger contains all the asset, liability, and stockholders' equity accounts of the company. The posting process transfers the information from the journal entries that we've already done to the appropriate ledger accounts. Okay, and so what we're doing, this is kind of our first stage of summarizing our information for the period. All right, so the example we looked at was basically, kind of like a month that we looked at. So now what we're going to do is summarize all the journal entries so we can start getting the ending balances in each account. All right, so how I'm going to do that is I'm going to go use T accounts. All right, so if we start right here, I'm just going to, for all of our accounts, and so I kind of know the order, so I'm going to try to keep my assets together first and then go from there. So we've got cash, and what I'm going to do is just create a T account for each one. Now the cash one's a little bit bigger because we had a lot of transactions affecting cash. All right, my second one will be accounts receivable. Make a T account for it, and then I've got inventory. And I'm just going to abbreviate all these. And then I have land. And then we also had machinery. I'll put that over here. I think I've got room. And then we had our contra asset account. Remember, we had the accumulated depreciation for the machinery. So we'll create that account. We had accounts payable, so now these are our liability accounts. We had a note payable. We had common stock, so that's now getting on to the equity side. And then down here, we had, let's see what was next. So we had sales revenue. So these are our income statement accounts, but remember those affect equity because they get closed out to retained earnings. We had cost of goods sold. We had a couple of expenses. We had interest expense. We had salary and wages expense, and I'll just abbreviate that as well so we can squeeze everything in here. And we had depreciation expense. All right, so what I'm going to do now, and so if you need to, you might want to stop and go back and watch lesson 3. But what I'm going to do now is go through each transaction and just simply post what we did in those transactions. All right, so our first transaction, if you look back, was we issued stock for $80,000 in cash. And so that journal entry was a debit of $80,000 to cash, and then a credit to common stock of $80,000. All right, so that posts that to each ledger account. And so I'm just using T accounts to help illustrate that. Our second one is we purchased machinery for cash for $11,000. All right, so that means we have a debit to machinery for $11,000. And now we have a credit to cash for $11,000. All right, our next one is we purchased $20,000 of inventory on account. So we have a debit to inventory of $20,000. We bought it on account, which means we didn't pay for it now, which means we have accounts payable of $20,000. All right, our next one is we purchased land, and we did that by signing a promissory note, which we call note payable. So remember, we didn't pay cash for it, but we'll sign a note and we'll pay that off over time. So $22,000 was the land, and then we had a credit to note payable for $22,000. All right, we then sold $8,000 of inventory for $12,000 of cash. So remember, this one had 2 journal entries, so we'll take the sales side first. All right, so we had cash of $12,000. We sold it $12,000. We sold it for $12,000, and then remember that is our sales revenue. which is a credit, but we sold 8,000 of inventory. So we had a debit to cost of goods sold of 8,000, and we got rid of 8,000 of our inventory. All right, so you can see now, we can see that balance is 12,000 if we're keeping up with that, but we'll summarize everything at the end. All right, our next one was we paid for half of the inventory purchased in that earlier transaction. So remember, we bought the $20,000 of inventory right here, and we had the accounts payable. Well, now we're paying off that note. It says we paid half, so 10,000. So remember, that's going to reduce our accounts payable by 10,000, but we're paying for it now, so it reduces our cash by 10,000 as well. All right, our next one is we paid off the promissory note that we signed when we paid the land. So we're paying that 22,000. It also says we had interest of 1,000. All right, so what's happening here is there's 3 accounts being affected. We're paying this off, 22,000. All right, it also says we had interest, that's interest of expense, of 1,000. So really what we're paying here was 23,000. So my credit to cash up here was 23,000. So once again, all I'm doing is taking the journal entries we did in the previous lesson and just now posting them to their appropriate accounts. All right, our next one is we sold some more inventory. All right, we sold this on account, which means we're not getting paid yet, and we sold it for $6,000. All right, so we'll take the sales side first. We had a sale of $6,000 on account. All right, so that's a debit to accounts receivable instead of cash because we haven't been paid yet. All right, and then we have some more sales revenue down here of $6,000. On the cost of goods sold side, we have it says we sold 4,000. It was 4,000 worth of inventory, so we'd debit cost of goods sold, and we would credit inventory for 4,000. All right, our next one was we collected $3,500 from customers with account balance. So that's dealing up here with this 6,000. All right, now they're paying 3,500 of it off. So that's going to reduce that by 3,500 because they're paying it, and it means we've now collected the cash of 3,500. All right, the next one is we paid our employees their wages of $2,300. All right, so that's going to be an expense to the company. So we have salary and wages expense, $2,300, and then we're paying them, so that comes out of our cash. So we'll credit cash for $2,300. And our last one was we had depreciation expense of $110. All right, so that's $110 of depreciation expense. And then remember, the credit there is accumulated depreciation. So remember, accumulated depreciation here is a contra asset account, so it has a normal credit balance. All right, so what we've done now is we've posted everything. So now our last step here is just to get totals. All right, so when if you think about cash as a normal debit balance, that means all the debits on this side are positive, all right, and then all the credits are negative. So all we do is net this together. All right, so this works out to be 49.2. So that is our cash balance after all these transactions. All right, we'll do the same for accounts receivable, and it's 2,500. So that makes sense, right? They bought 6,000 on account, which means they owe us 6,000. They paid us 3,500, so 2,500 is still left. All right, our inventory balance is now down to 8,000. That's how much inventory we have left. All right, land, nothing happened, so it's still 22. Machinery, nothing else happened beside the first entry. It's still 11. Accumulated depreciation is 110. Accounts payable was 20, but remember, we paid half of it off, and so now we still owe the other half. So that's a liability. Notice it's a credit balance. And once again, notice that top row up there. All of those are debit balances. All right, they have to end up as debit balances because they're assets. Now that we're down here to these liabilities, accounts payable and notes payable, they either can be zero, like note payable. So remember, note payable, we paid it off, so it's now zero. Common stock is 80,000 credit. Remember, equity accounts are normal credit balances. Our sales revenue for the period, sorry, it's a bad line there, $18,000 was our sales revenue. Cost of goods sold for the period is 12,000. So you can see if we wanted to start thinking about our income statement, sales revenue less cost of goods sold gives us how much profit we made. All right, and then we have our 3 expenses here. All right, we only had one of each, so we don't need to do the subtotal. All right, so now what we see here is we've got a balance, an ending balance for each of these accounts. So if you look at the top of the page, our next step is a trial balance. We're going to start listing all these accounts out. So this point, this part right here isn't the very difficult. All we're doing is taking the journal entries that we've already done and posting them to their appropriate accounts so that we can get an ending balance for each. and then that's going to help us lead into being able to do the all of our financial statements at the end of each period. All right, so the next lesson that we'll do will be dealing with the trial balance. All right, so be sure to tune in that. Hopefully you're enjoying these videos. If you do, please subscribe and like the video. I appreciate everybody checking this one out.